Welcome back, traders and investors, to Benzinga's Flea Market Prep, brought to you by MarketFi. I'm your co-host, Joel L. Connon, along with Brianna Valesky. We have Nate Tobik on the line. He's an investor and founder of CompleteBankData.com. Nate, how you doing on this Thursday morning?
I'm doing very well, Joel. Thanks for having me on again.
Hey, I know we've asked this before, but could you give our new listeners a little idea about your website and the information you provide?
Sure. So, Complete Bank Data is a financial information provider for financial institutions. So, we are a database of all the banks and bank holding companies in the U.S. going back to 2003, and you could use it to generate investment ideas, research current holdings, find out new things about banks. So, it's a comprehensive solution for bank investors and bankers.
Now, 2003. Why did you pick that date?
Well, we originally started building this in 2013, and so we wanted to have 10 years of data. So
There you
it
go.
was 2013 to 2003 was it.
Okay, so let's get into some banking issues, and you have just some overall notes here, and maybe touching on some auto loan discrimination charges.
Right. This is some news out recently, which is really interesting. So the Consumer Finance Protection Bureau, the CFPB, cracked down on Fifth Third with an $18 million fine for discriminating against car buyers. So this is something every consumer knows is happening, but apparently now it's frowned on. So what's going on here is you go into a car dealer and they run your credit and they say you're a great credit. You are about a 4% interest rate, we'll say, for your car loan. And the dealer says, you know what? I think we could maybe mark this up. We'll do 4.5% or 4.25, and they tack on a little bit of extra interest to juice the deal on their side. And so this has been going on for years. Seems like every dealer's doing this. And what ended up happening is the CFPB came out and looked at this and said, well, dealers are discriminating against minorities, and they're actually marking up the interest rate even more. And this has nothing to do with credit worthiness. So the bank was making they were making the credit determination, and then the dealer said, well, we'll add some extra interest on top of that, just for pure profit. And so it's interesting that the bank is being hit hard here and not actually the dealer. And the reason is because the bank is allowing this end user to make these extra decisions, even though it has nothing to do with the credit worthiness or anything related to the loan. So I think we're going to start seeing more fines and more issues like this coming out as the CFPB really starts to investigate how banks are making their money, especially with consumer loans, a lot of these different types of credit cards. I mean, there's tons of credit card lending out there, and now we're seeing it with the auto lending. So they're really trying to figure out, they want to level the playing field for consumers, and some of these practices that everyone kind of understands has been happening for years, a wink and a nod to dealers making a little extra money, that I think we're going to see that stuff go away.
Okay, now Fifth Third is caught the brunt of this. Or there's some other banks that you think might have some exposure.
Well, Fifth Third caught the brunt of it. It's only an $18 million fine, which in the grand scheme of things is really nothing to them. But it sets the tone for other banks. So we don't know specifically who else is doing this. My gut feeling is pretty much every bank that does auto lending is allowing this to happen. So I think what the CFPB was doing is they wanted to set the example and come out with a big fine against someone, and then hopefully that'll curtail the practice for the rest of the banks.
Okay, and any other ones that you think might be having some exposure to?
So not specifically to the auto, but in terms of exposure, another thing to look out for is the exposure to Glencore right now. So
Okay.
the issues with Glencore, the mining commodity business in Europe, there's been a couple notes out that U.S. banks could have almost $100 billion worth of exposure to them. And specifically, some of the largest banks, maybe $300 to $400 million worth of exposure, because most of what Glencore did was it's unsecured. Most of their debt's unsecured. And apparently, American banks gobbled this up. And so if they run into to issues, and there's, a lot of people are saying they might end up bankrupt, that could be a serious hit to a lot of banks' balance sheets.
All right. Our last guest talked about exposure in the derivatives arena and some of the big boys really increasing their exposure to derivatives. We know that cannot be a good thing sometimes. J.P. Morgan's been buying loans from small banks. I mean, think they're going to have any exposure there?
This is, I think so. And I think this shows a couple things. It shows, number one, that when you get to be that giant size, like JP Morgan or Bank of America, it's really hard to get that loan volume. So what JP Morgan has done is they're now buying loans from small banks. So in the last quarter, 62% of their loans were purchased from smaller banks. So the small banks are benefiting because they could originate these loans and essentially dump them on JP Morgan. The problem for JP Morgan is they're buying so many loans to get that volume that they need that they can't possibly look over each loan and say, we like what this is. Even on the aggregate, they're just making some assumptions as to the credit quality. So they're really relying on the smaller banks. And so, maybe 85, 90, even 95% of these banks making these loans might be making great loans, but you only need a small percent that are throwing some junk in there to cause a problem. And so, if the economy's humming along, then J.P. Morgan might never see this risk. But I mean, as we know, things aren't humming along as everyone would really expect. So it's possible this risk could definitely show up.
You're scaring me here, Nate. I don't want to have a 2008 like crisis again. I mean, what's the basis of these loans? Are they some of the home loans? Are they smaller business loans? What kind of loans is J.P. Morgan actually buying?
I don't know the specifics. My guess is it's a lot of residential loans, but right now where banks are seeing growth is really with the commercial and industrial loans. And so that's a lot of small business lending has been ramping up. And to coincide with that, I saw a report yesterday that said that banks are loosening their small business lending standards. And so whenever there's an increase in volume in lending and there's a decrease in standards, that's where you could see issues. So we have all these commercial loans being made. Banks like them. The yields are higher, and we're also lowering our credit quality standards on these same loans. The economy isn't perfect. So is it possible that if we hit a recession, and we could see some problems coming through the bank balance sheets? I think absolutely, because it's that multiplier effect. So banks are lending to small businesses, and small businesses tend to get hit the hardest in a recession, and they're going to default on their debt pretty quickly. The business might still be around. It might be a new iteration, and that's going to trickle up through these balance sheets.
Still Partners Web Bank holding a valuable gem hiding inside of a weird fund. And you said it does lending for the lending club. Are we talking about exchange traded fund here, or what are we talking about?
No, so this is an interesting idea. Lending Club is getting a lot of press, and the way Lending Club works is Lending Club is not a bank. They have a bank originate their loans, and it's Web Bank. It's a very small bank in Utah. And so what happens is Web Bank will originate the loan. They do the credit quality checks. They keep the loan on their books for 2 days, and then they sell it to Lending Club. So they make 2 days worth of interest. They get an origination fee. And WebBank is not publicly traded, but WebBank is owned by Steel Partners, which the ticker is SPLP, and they are traded. So what's really interesting about this is they earned 10% on their assets. They did about a 50% ROE. They're extremely overcapitalized, and it's almost this, I don't want to say riskless, but there's not much risk because the loans are being sold within 2 days. And Lending Club passed through $4 billion of loans in the last quarter. And so, you say 2 days worth of interest doesn't seem like that much, but when you look at the raw volume, 2 days of interest on $4 billion really is a lot. And so WebBank, they made about $7 million last quarter. So if you look at Steel Partners has a 450 million dollar market cap, I believe, and they value WebBank to be about they value it at book value when they look at their own holding. But if you were to break WebBank out and it were to be a traded bank, it's probably worth between 250 to 370 million, which is almost all of Steel Partners' market cap. And Steel Partners has another $500 million in investments and equity interests in other industrial companies besides WebBank. So if you buy Steel Partners, you could own this extremely valuable bank that's clearly undervalued because it doesn't have this public exposure, and you get a bunch of other investments with it. And the kind of the ding with it is it's a publicly traded partnership. So
Symbol?
it's
Do you have a
essentially,
symbol?
go ahead.
Do you have a symbol?
It's yeah, SPLP.
Okay.
It's like a hedge fund that trades. So
Hmm.
there's there's about a 1.5% performance or management fee that's paid to the managers quarterly, which is a bit high. And it's working kind of like a hedge fund, but they have these really valuable holdings, including WebBank. And I think as Lending Club grows, that's going to become even more valuable.
Yeah, this stock has held up kind of well here. Kind of interesting technical pattern or this partnership unit. I might have to take a look at it. Little diversification. Any takes or input on business development companies like PSEC?
PSEC. I these have been getting a lot of traction recently, and I'm not sure why. I guess the market moves in fads, and this seems to be a big one right now. Is the business development companies, and they could actually be great investments if you look at who the managers are, what they're investing in, and what's their risk. So the danger to the BDCs is if they just start pushing through a lot of volume, and because they want to earn the small business lending, the fees for originating these loans. So if they're just pushing through a ton of volume, regardless of the credit quality, that could become an issue. But if credit quality is in check, these could be good investments for sure. It's kind of like a private equity, small business private equity type company.
All right. Thanks for that question from Bobby Biddy. Moving on here, Nate. We always get some banks out of you and some small banks. I think it's a competition between you and Tim Melvin. Tim does his homework as well, like you do. Likes these little banks. Sometimes they're trade by appointment only here, but give us a look. You got some small banks on your radar.
Right. So one that's an interesting name that I like is Penn Woods Bank, PWOD. And so what I like about them is they have a 4.6% dividend yield. So this is more of a dividend play. It's dividend and growth. And they've got about a $190 million market cap. Nice dividend yield. They're slightly undervalued on value metrics, I guess you could say.
Book
But the
value?
bank's really
What's
big.
their book value?
I don't have the.
Okay, go ahead. That's fine.
Yeah, I think it looks like they're trading for about 1.6 times tangible book. So they're let's see. So I guess book
A
value
little
would
higher.
be 28 a share.
Ooh, okay.
Yeah, and but they're growing well. So they've got a 10% return on equity. They're over the $1 billion in asset threshold, and they've been growing. So this is if someone's looking for a well-run bank that could be put away for a couple of years, you collect the dividends in 3 years. So you say 3 years from now, you're going to get the 4.5% dividend, plus you're going to get some growth out of it. I think it's plausible to see this being close to a 10% return if they just continue business as usual.
Okay, that doesn't sound bad to me. I'm not picky. What else do you have on the small bank radar?
Yeah, so another bank, and this was actually mentioned the last time I was on the show. Someone asked about Bank of California. The ticker is BANC. So that's a coveted ticker, I'm sure. And they're interesting. They're kind of, I guess you could say, they're really a symbol of kind of the empire building type banks that we're seeing out of the crisis. So these guys, they've purchased two specialty finance companies. They bought a broker dealer, and they bought some branches and three banks, all since 2011. And so 2012, actually. So in the last 3 years, these guys have been on an acquisition spree. They've got over $6 billion in assets. They trade at tangible book, and they've increased their return on equity from 5% in 2012 to over to 10% now. So they've gotten to that coveted 10% metric. They've increased their net interest margin. They've pulled up their loan yields through a lot of these acquisitions. And so this is something that really should be trading for maybe 1.5 times tangible book, if not more, if not at a premium, because they're out in this acquisition spree. So, there could be a 50% upside with this bank for sure.
Yeah, that sounds like a nice upside. Have I ever asked you about a small bank called Monroe Bank and Trust? Have you ever done any? I'm from Monroe, and that's why I've done some investing in it on and off all the years. Tim Melvin actually mentioned it to me on the show one day without even me asking. It's a small regional bank. It's been around since before Custer here. Any takes on that?
I, you might have mentioned the name. It sounds familiar. I'll have to take a look.
Okay.
I don't remember offhand, but it's up in Michigan somewhere, right?
Monroe, Michigan. That's where I'm
Okay,
from. Yep.
Monroe, Michigan.
All
Yeah.
right.
Yeah, I'll take a look at that one. That's Tim, so Tim is great. He's got a lot of good ideas on these small banks, and I'm on his email list, and it almost hurts to get emails from him sometimes, because it'll be, oh, this little bank was sold and for a 70-some% gain or a 50% gain, and their names I've looked at, and you can't buy everything. So it seems like his picks are always the ones that are being bought out, and I've got all the other ones.
You're due. No, I mean he does his homework, and I mean he'll sit on something till the cows come home. He really has that long term investing mentality. He's we have him on the show quite a bit. He's great. Do you do? I mean, for your personal investing, do you only do you do anything outside the banking sector?
I do. Yeah. I invest in a number of companies. So banks are probably 35% of my portfolio. So the rest of what I own are small, just kind of, I call them oddball companies. So something like Steel Partners,
Uh huh.
or some very small companies that rarely trade, something like a Cop Glass,
What's the
which
symbol on that one?
KOGL.
Tell us why you like that one.
So they're really interesting. They're a niche glass manufacturer, and they kind of are this thesis of, they're the last man standing. So they make the glass for railroad signs, the flashing ones for train tracks, and they make the glass that goes on the lights on airport runways. So this was a big industry 100 years ago, 120 years ago, and everyone else went out of business. Everyone else went to plastic, and they're still around. So they do 20 to 30% return on equity. They pay almost all of their earnings out as dividends. It's between a 7 to 10% dividend yield, and it's a closely held company. And there's really not much competition. The problem they face is they can't scale. So they've got this great little market. They kind of mint money in this area that they're specialized in, but they can't grow. So it is what it is, and you could sit on the stock, collect a dividend. It's appreciated pretty nicely in the last 2 years, but that's it, and it's very hard to get in and out of. So
Yeah,
you
I
need to,
can tell.
yeah.
I'm just looking at it. So if you buy it, it looks like you're going to be stuck with it. All right, Nate Tobik. He's an investor and founder of CompleteBankData.com, giving us a couple issues to look at. Nate, thanks a lot for coming on. We'll speak to you again soon.
All right, thanks for having me.